You can't replace part of the brain. Like, you
treat them the same.
A source of truth for the medtech industry.
Coexists with the province.
Robot understands things automatically.
Number one show in the medtech industry.
So Stryker got ahead of that and changed in the 90s, built $1 billion company that held up high, a lot of things.
State of MedTech.
With your host, Omar and Khatib.
Hey everybody, welcome back to the show. I'm joined by my good friend David Kereiakes, who is managing partner over at Windham Capital. While this is a venture capital episode, David and his firm is really focused on commercial stage and growth stage companies. We're going to get into all that and more. David and I met at, of course, my favorite event of all time. If you're a listener of the show, you know what I'm talking about, and that's LSI. He's on a great panel, so I had to have him on the show. David, thanks so much for joining us. How you doing?
Doing well. Thanks, Omar. I appreciate you having me on and giving me an opportunity on this platform.
Oh, totally. And, before we jump into sort of the more fun topics of what's going on in the medtech markets and so the investments that you guys like to make, you have a really unique background given that, you were with a health system prior and a nonprofit side, and now you're, in a different world. Give us a little bit of your background for some of the investors and individuals who are just learning about you now.
Yeah, I appreciate that, Omar. So uniquely, I come from a family of physicians, nurses, scientists on both sides. There's probably near 20. And so healthcare has always been familiar to me and a passion. I looked at it to going into medicine and seeing the burden that was placed upon my family members in delivering care. I thought ambitiously that I could have not only an impact on patient care, but the lives of those delivering care from where I sit. So I'm privileged to have been granted an opportunity now 12, 13 years ago. It was not an easy route in, and it's probably for another discussion because it will take that long to talk about how I managed to claw my way into being able to invest in healthcare and work for a venture growth equity fund. But I started my career with a traditional institutional investment fund. I had an incredible mentor that taught me a great deal about medtech investing specifically, also healthcare services. And then we started to venture into digital health and software. I made my first software investment about 10 years ago and realized that healthcare was grossly behind the other industries from the benefits of what software could enable and efficiencies that can afford, and knew I had to get smarter on it. So fortunately, I was able to, it's a small ecosystem and we work very closely with one another. And I admired and respected the work that was being done at Providence Ventures and the opportunity to pick my family up from Cincinnati and move 2,000 miles away. Not only the miles, but we had a 1-year-old and my wife was 7 months pregnant. So a very big move for us. I think we collectively spent 12 hours in Seattle before making that decision, but ultimately was able to work within Providence, the third largest nonprofit health system in the country, but a very forward-leaning, innovative system being headquartered in the city of disruption, I call it, in Seattle, and having to, in order to remain competitive, really start to adopt and incorporate digital health and software solutions. It also was fascinating to live within a 180-year-old faith-based nonprofit health system, and see how they think, how they behave, how different departments are incentivized, and be fortunate to help drive innovation for that system and investments, trying to find new revenue streams and enhance margin for Providence was interesting. And then getting to work for the incredible team within Providence Ventures, and then uniquely a C-suite that was half big tech. And the gentleman I reported up to and was fortunate to learn from, helped launch Kindle for Amazon, and came to into healthcare to help digitize and bring Amazon's culture into a 180-year-old nonprofit. But it afforded me the opportunity to see how big tech thinks and behaves, and the culture and how they view strategically, right? How they view strategy, particularly in healthcare. And so, after 5 years there, I ended up joining Windham Capital Partners and partnering with Adam Fine. Adam launched Windham 15, 16 years ago, and uniquely as a long history in pure medical device investing, as well as digital health and software. And now uniquely, we're well positioned to capitalize on the growing trend of tech-enabled devices, smarter devices, software that has regulatory risk, and a space that a lot of people just don't have a clear understanding of or comfort level.
That's fantastic. And yeah, I think, this is one of the reasons why I have you on, because you have such a unique background and different perspective. I think like one of the keys to, in my opinion, is, some of the great investors that they have a very broad experience and background. And I think that, deploying capital is very much like solving a problem. So the variety of different biases and perspectives that you can sort of bring to the table really allows you to do like really good due diligence and see things that most people don't. Unfortunately, like venture capital, I think a lot of people think about it being really innovative, but a lot of times venture capital ends up being just, sort of following what everybody else is doing. And so it really takes like unique investment perspective to find those quote unquote unicorns, because, if everybody invested in them, they wouldn't be unicorns, right?
Right. No, you're exactly right, Omar. I love to go where the crowd is not, whether contrarian investments or operating in spaces that aren't frothy, aren't sexy, and don't get a lot of attention. So I think you're exactly right.
Well, and I think also, I want to, ask you a little bit more about Wyndham's, investment thesis and how you guys think about things. But just a comment, like, and I'm sure you would agree, especially considering that you got exposure to big tech. I think it's such an exciting time to be in healthcare for a couple reasons. Post-COVID, there's been more public awareness and interest in health and medicine. Some random examples. I mean, first of all, like continuous glucose monitors. Like, who would have thought that people would have are paying cash to get a continuous glucose monitor because they're just interested in their health? Popular shows like the Joe Rogan show. I feel like every other episode where he has like a fighter from the UFC or something, they're talking about a certain orthopedic implant they got, and different approaches to surgery. And the other side is that if you look at the big tech companies, Google, Apple, Microsoft, Amazon, they all have a fiduciary responsibility to grow. And Apple's not going to wake up one day and say, "Hey guys, like let's go into the furniture business," right? We spend almost, a little over 20% of our GDP on healthcare, and it's not. I wonder if what do you think about this? Is that I don't think healthcare is a $1 trillion industry. I think it's multiple billion-dollar industries all like one, right? Would you agree?
I completely, and I would even go even further and say it's multiple $100 million industries. I mean, I think that's where tech investors that didn't traditionally invest in healthcare during the robust years of 20 and 21 came in and didn't have a full appreciation for that specifically. It is hard to find billion-dollar markets, and in an investment horizon that we're looking at in 5, 7, sometimes 10 years, but ideally shorter. It's hard to find those and access those markets. And so you're exactly right. And you touched on the trillions that we spend. We spend over $4.5 trillion is a U.S. healthcare spend. That's third largest GDP. If it were its own country, it's ahead of Germany and Japan, behind the U.S., obviously, and China. But I don't see that we're getting the benefits from that kind of spend. And as sad and depressing as that is, we spend over $13,500 per American here. There's huge, there is an efficiency. You don't look at the U.S. healthcare system and say, this is a good example of an efficient economy and in prime efficiency. And not too long ago, I reference this because it stuck with me. 7-8 years ago, McKinsey did a study on the digitization of industries. This is a measurement of progression and efficiencies, right? U.S. healthcare or healthcare in general was third to last. It was behind government, but ahead of agriculture and hunting. And I think agriculture soon had a lot of tech investors come into it shortly after that and quickly passed healthcare. But to your point, there wasn't a consumer, and there hasn't been a consumer in healthcare. There are patients, providers, and payers and others, right? One of the things we were trying to do at Providence in the 2015, 16, 17, 18, and where I stepped into a little bit later was enabling a consumer. We thought big tech was going to be doing that, to your point, Omar. But it really was COVID. It was the pandemic that forced an industry that this is the way things have always been done to try new things. There were departments, and I won't pick on any particular department openly here, but generally 20, 30-year career within the same health system, moving up the ladder, that, don't want to lose their job by taking a risk. A risk being bringing on a startup, trying a new technology, implementing that. And so there's a reluctancy to adopt, particularly in this department. What we were seeing in 21 and 22, based on some market headwinds, they were coming to us at Providence Ventures and saying, what do you have? What have you seen? Doesn't matter that this company had been launched 6 months ago. They needed answers, and they needed solutions based on how challenging the environment was. So it's given that overarching kind of dark, concerning situation we find ourselves in the U.S. healthcare, the opportunity ahead of us for innovation and efficiencies has never been greater. I don't think there is a part of the economy that has such growth potential and upside and need for change as healthcare.
Yeah, well said. And I mean, I completely agree. And, maybe good segue, which is for Windham Capital, of all the places you could have gone, why them? What's their investment philosophy, and essentially how does Windham essentially differ from some of the other firms that are out there?
Yeah, so I found a counterpart and a partner in Adam that shared my core beliefs to do well, right? To drive good investment returns first and foremost, but really have an impact because the healthcare system, in my mind and many others, is broken, and it needs to be helped and supported. And in no other industry can you have a direct impact on your community and enabling others to live their best life as you can in healthcare. And so I found that in Adam and Windham. I also uniquely found another investor that has a long history and skill in investing in pure medical devices and pure digital health and software, and having an understanding, an ability to deploy capital and advise companies and build companies in both of those verticals makes you better in the other. I think it really does. Since I went to Providence and continue to build out my understanding of how to invest in software and digital health, my med tech investing skill set has sharpened and has gotten a lot better. And I think we're well positioned now to operate in a space that very few have understanding or comfort in. Healthcare is very siloed, particularly within a health system. You have surgeons that use devices, and they're deep inside of the hospital, in the towers, deep in the catacombs, and they use a tool, they operate with it, and they get it. Administrative leaders don't use devices, and they're separated from them, and so docs also, surgeons also don't use software so much or have an understanding of how Epic and, it frustrates them based on their use of EHRs and medical records. And I think a lot of them are interested in understanding what unique insights and data you can pull from it. But there still is a lot of education that's needed to happen. And so it's very siloed. There's discomfort in moving between both. So having that ability to help bridge that gap and translate on either side is a unique place for us.
Got it. That makes sense. And yeah, just I mean, checking out your guys' website, you guys have made some fantastic investments over at Windham. I mean, just to name a few, CVRX, which is IPO'd, Cartiva, which was acquired. One of the big ones that got my attention was NeoTract, which was acquired by Teleflex. Has a great story there. I2 Biopharma, another one that was acquired. But again, what I like is that it's a nice mix of both traditional med device and then SaaS, which I think is interesting because right now there's a lot of investors who don't know how to evaluate a med device company that's trying to also incorporate some sort of SaaS model, right? I think a lot of, and you worked at a health system yourself, a lot of health systems are not buying the, stereotypical razor blade model, which we often see in surgical robotics. And so this need to have not just innovative product, but business model innovation is really needed. And so I think that's very interesting that you guys have that in your background. Given, let's talk about like how things are today. The price of money is really expensive. Inflation is kind of out of control. The Fed told us, hey, we're going to give you 3 rate cuts this year. Not a single one's happened. I don't know if we're going to see one until after the election, how does that affect your ability to not just to deploy capital, but also, for you guys, you're looking at growth stage and commercial stage companies. Unfortunately, in our space, it's rare that you see that hockey stick curve that you often see in SaaS companies. So the ability to discern what's going to get traction is difficult. How do you go about doing that and evaluating companies?
Yeah. So it's a unique position for us to be in, to be able to flex between devices, software, digital health diagnostics, or the gray area across all of them. It is a very challenging environment right now for capital. There is a big shortage, and our industry goes through cycles naturally. I think what we saw in 21 and 20 was a huge surplus in free money. And a lot of new capital being deployed that didn't have a lot of expertise or experience, particularly in healthcare, which saw majority of a lot of those dollars. That tide has pulled out, and now there is a huge shortage of capital, which is concerning. I think it's overcorrected, that there is far less capital. Last year it was abysmal, and this year Q1 is starting to come back and showing really good signs. We're already on a good track and potentially 40% growth based on Q1 numbers compared to last year. And if you, and I think it's continued through Q2 just from what I've seen. And so there is capital out there, and there's kind of a bifurcation in quality of deals. So if you do have growth and you do have capital around the table, so insiders still have money, I think these companies are getting really good valuations. They're raising rounds and not distressed. Unfortunately, we see a lot of distressed companies. I think over my career, this is probably the most compelling investment environment that I've seen. There are incredible opportunities. There's no shortage of deals out there, and so I'm excited about where we will end up in 3, 4, 5, 6 years from now. I think that the tide is coming, the market is getting better. And in downturns or shortly after downturn markets, venture returns have outperformed. And where we've seen large institutions and then the allocators from the very top move away from or be overextended in venture coming out of 21 and 20 and 21, those that are deploying capital today, I think will have the best vintages we've seen, particularly in med tech and digital health software investing, and others that we've seen in a long time.
Yeah, let me ask you. I think you tell me if you agree with this. I feel that when you're looking at an investment, it's slightly easier if it's a medical device or hardware to sort of see like, okay, this is what they've currently sold. This is what their commercial pipeline looks like. Like you have a good idea. The area where I think where a lot of investors have been burned, but there's tremendous opportunity if you get it right, is the digital health side. How do you go about evaluating a commercial stage digital health company early on before everybody else is banging down their doors to throw money at them?
Yeah. So I said, being a good device investor helps position you to be a better software investor and vice versa. And to your point, I think device investors are really good at sizing a market and understanding the use case and developing a succinct ROI, both clinically and economically. On the other side, software investors, they can often miss on market size. You don't have CMS data that says this is how many procedures, or you don't have data that says this is, I see 10 patients a day, or I do this procedure 30 times per month, and you can extrapolate a market size that way, which helps inform the cost of capital and the execution risk and a lot of the stuff, the calculus that we undertake. I think for software investors, it's important, and something I always try to adhere to is, can I own the outcome? Can I own the ROI? And can my software or digital solution take credit for that, and then quantify what that is? So, oftentimes it's in a noisy environment. It's hard to, it's not as easy as I implant this device, I use this solution, and patient, doesn't come back in 30 days. There's no 30-day readmit. And then I don't see them, or is living a better life, 5, 10, 15, 30 years from now. You can follow that very easily and do clinical trials to help support that. Software, it's less, I think less easier to do that. So, on device investing, I didn't realize this until later in my career, that I was looking at buckets of risk. And, as an investor, that's what we have to do. We have to quantify risk, or evaluate where are the potential pitfalls in this particular investment opportunity, and how do I mitigate that risk and then add value. If I'm going to charge for the capital that I'm providing, I want to more than pay for that in the value that I can provide as a partner, as a board member, as an advisor to the business, and my ability to help the company grow. And so that's important to me. I don't want to be along for a free ride, but in devices, there's 8 buckets of risk that I attribute that you can have somewhat control over, and you can take, before I go through them all, you can take about 2. You can take 2 buckets of risk in yellow flags, not red flags, but yellow flags, because you can help address or mitigate that risk in some form or another, on top of bust risk or hurricane risk or pandemic risk, just macro stuff that you can't see coming. And so, yeah.
Well, I was gonna say you said something very important, which we love on the show, which essentially are mental models and frameworks. So I would love if you can go through those 8 buckets of risk, and how do you actually use that as a sort of guide, a guidepost for you when you make investments.
Yeah. So I don't know if this is secret sauce. It's not in a textbook, and I don't know if you'll see it in a textbook. It's in my head. So, the 8 buckets, most importantly, management talent, right? The secret of my success, and other investors, is investing in incredible entrepreneurs, those that have great communication skills and a passion, an unwavering passion for what they do. And so I've been fortunate to invest in a lot of incredibly talented management teams. So that's one bucket of risk. You have a first-time entrepreneur, they're not going to be aware of what they don't know, and you want to find somebody that asks questions and is aware of that, and is humble to that point to be able to seek guidance when needed. Market size. I'm not afraid of a small market. As we talked about, I think a lot of investors get lost or look unfavorably on the $200 million market or a $300 million market. But if there is a focus on capital efficiency, there is as good of outcomes in those markets that are underappreciated, under targeted by large med tech investors or corporates, or large digital health companies, software companies that are chasing these billion-dollar markets. Unfortunately, once you get to a billion-dollar market or greater, there's only a handful, if that, companies that are able to afford to pay for or acquire those companies. And so you narrow your acquirer universe naturally by the way you price an investment in the market that you're deciding to go after. And you leave really the IPO markets, which is more of a financing event than an actual sale, and you're beholden to the macro environment. And there are paths to that, and there's great money to be made there, and huge value to add. I tend to not want to bet the house that the head of business development or corp dev, the CEO or the board is willing to put their job on the line to say, I need $1 billion or $2 billion, $3 billion to acquire this business. That takes a little more risk. It often takes a lot more money on the front end too. So I can belabor each bucket of risk and why it's important to evaluate them, but it's management, market size, competitive dynamic, ability to execute. Some companies are very aggressive, or this is a vital organ, and they're harder to sell against, hence needing more money to invest behind it. One of the biggest risks is reimbursement risk. Who pays for it, and what do they pay for it? Regulatory risk, IP, technology risk, supply chain and distribution. I've learned over the years that if you have a highly complex device, and this is fortunate that I learned before the supply chain issues that we had in 2020, that can have a huge impact on the likelihood of success. And clinical trial risk, I view as a kind of an eighth risk to round it out. And when you evaluate all 8 of those, I think it's okay to have 2 as yellow flags, because then you can appropriately price the risk reward necessary for additional capital to go into that company.
Yeah, that makes a lot of sense. And I'm curious, of those buckets of risk, which one do you feel that which one do you see most often with med tech companies where because of the fact that that bucket has been checked off, or like they haven't de-risked it, they lose an opportunity for funding? So we have a lot of startup founders and entrepreneurs who are listening that they're either pre-commercial, they're just getting to their commercial phase. And so I always feel that it's best for them to hear directly from investors like you, like, here's the things you should think about doing from now, so that they're not having to backtrack and do them when it's already too late.
Yeah, it's specifically in devices. I think reimbursement risk is one of the more challenging ones, and it's not yet solved or figured out. Breakthrough designation has been helpful. The Medicare coverage for innovative technology, which was repealed, then replaced with transitional coverage for emerging technologies, which offers payment for breakthrough devices, is a step in the right direction, but it is challenging to deploy capital and invest in early stage companies with that risk. So the earlier you can start quantifying the economic value and ROI of your device, the clinical value paired with the clinical value of your device, the better off you are. But this is not an easy space in general. So when you're looking across all of those buckets of risk, and I don't want to belabor too much and sound too boring in what I do. A lot of it is believing in the entrepreneur and helping to support them, and by doing that, great things happen.
No, I completely agree. And maybe I'm curious, not to put you on the spot, but again, as we talked about earlier, the price of money is expensive these days, but also capital is a commodity. And so, in a world where if you are a darling of a company and you can take money from everybody, what kind of things do you do over at Wyndham in terms of supporting your entrepreneurs, like outside of just capital? And I always ask this because every investor sort of has their own thoughts around what's valuable and important. So, just out of curiosity, like what kind of things do you guys provide?
Everything. I mean, I mean, we try to. I mean, so we have an incredible advisory board made up of some incredible people that have, are specialized in a variety of different areas, and then uniquely, Adam and I have spent history and time within corporates, whether the provider or big med tech, and spent time in understanding how they think and behave, how to navigate sales cycles. My time at Providence was fascinating to build a network inside Providence and across the country amongst other healthcare leaders, both physicians and administrative leaders, to understand how they evaluate a technology, software, or service, how different departments are incentivized around adoption, how they what they look to compare against, all of those things, and just introducing and educating to customers can help accelerate the growth. I mean, if I don't feel comfortable, this is a marriage. If I don't feel comfortable that I can add value, if not more than what I'm charging for the capital, then it's not an investment I want to do, because this is something that I'm going to be involved with, as a huge supporter and champion for the next however long it takes. So it is important. I mean, so there's, I viewed primarily there's two credit cards that everybody knows that a company has to leverage. One is equity, and the other is debt. Debt is, we saw a pullback last March for obvious reasons. So in March of 23, but with that void, a lot of new debt lenders have come into the space, and I find debt to be widely available. It just costs more based on where rates are, and so there are more banks providing and venture debt and lenders providing available capital, and you can get multiple term sheets on a company, and so you can still access the debt markets. Equity is becoming a little more challenging, and financing risk has gone up just based on a shortage of funds actively deploying in the space. I think a lot of funds took off, not entirely took off, but started trying to extend runways within their portfolio. So cash management became a very important focus for a lot of investment funds. And when you take that time away from the market, 18 months, 12, 18 months, it's hard to understand what's fair market value, how to price a deal, the kind of diligence. There's a reluctance. There's more challenges from other partners within a fund. And so new investments become increasingly challenged. Now, I see more frequently there's a third and fourth credit card to be used. One is your customers. So finding a way to have them upfront payment for whatever service can help, or device software can help fund the business. And then the fourth, you have to be a little more careful, and we're seeing a lot more of these, fortunately, unfortunately, in licensing deals and distribution agreements and selling rights to a particular market, or that may not be core to where the value creation for a business might be. So think dental or vet market for a surgical tool, for instance. Selling that application and the rights to the veterinary market can provide a windfall of non-dilutive capital for you in your business as an entrepreneur, that you can protect your equity and extend your runway for a market that you may not decide to go after or view as valuable. Now, when you start entering into those core markets that's where it becomes a little more challenging from an investor standpoint to see that you can have a auction like multiple potential buyers at the table when the appropriate time to sell arises. So that's how I view, one, the particularly for the entrepreneurs who are watching or listening here, other creative ways to extend runway and drive capital efficiency, because that's increasingly more and more important. And we lost track of that in 2021 and early 22. Those that are able to survive and extend runway here and meet those milestones that are necessary in order to increase the next financing and the value that capital comes in at, that's becoming increasingly important.
No, that makes a lot of sense. I'm wondering, like right now, seeing the convergence of not only big tech and data and med devices, you also see, um, I think our industry is still so early on in actually leveraging it, but these AI models and LLMs, are going to change the way a lot of these companies function. I don't think we're at a point where something like an LLM is going to completely replace like a really highly talented programmer developer, but you're definitely going to be able to get a lot more done in a shorter amount of time. So knowing all that, are there certain areas of the market, certain niches that you're particularly excited about, more interested in?
Yeah, no, there's there's plenty. As we talked about the amount of efficiency or the antiquated systems that plague our healthcare system, there's huge opportunity for uh, AI and LLMs to have a material impact on how we deliver care, particularly given the environment. Delivering care is a negative margin. Unfortunately, a lot of health systems are struggling to turn a profit because of a lot of these inefficiencies and just the cost to deliver care. So there are huge strides that we can make. A lot of health systems are looking at back office and non-clinical. There's concern in regulatory and compliance hasn't kept up. And so integrating that into the clinical setting is maybe a little more cautious. They're a little more cautious about. So less, meeting with the patient and touching the patient, but there's huge gains, particularly in rev cycle, in communications and operations, in the back office. So, one health system built a model to help the inbox. So the emails that they receive that patients send physicians can spend an hour, 2 hours of their day responding to emails. And just by integrating this model, this health system that we speak to fairly often and we talk to a lot of them, was able to remove 75% of all emails or shorten them. And when you look at the administrative burden on clinicians and what that little benefit or seemingly little benefit can do, you now have, 45 minutes more of your time available that you otherwise were tied to a computer answering emails and less practicing medicine. So there's, that's a small, like a unique early sign that we're seeing, but there's huge opportunity ahead.
Yeah, something you just made me think about. Like we see a lot of innovation for clinicians, which makes sense. I don't I don't even know if there's a market for this. There has to be, but like um aside from like some dashboards and stuff for like revenue and everything, but I don't know if anybody's thinking about like, hey, what like really amazing solution can I create for like a hospital CEO that they can't live without? Maybe I'm wrong because I just didn't think about it until right now. But do you know of anything? Because I personally don't.
Yeah, by being a good software investor, it helps you think more strategically and what you can do and accomplish. So that train of thought is something that I think benefits medtech. And so, for instance, helping to enable a consumer and speaking to a consumer, a patient be prior op, then pulling data from that operation and then following them post-op can drive far greater outcomes and steer patients that are better qualified on the front end to your device and the procedure that you help enable and drive greater outcomes. Thus, you're going to be chosen more, and your device is going to be hold reimbursement longer and be better positioned in the market. And so, a lot of device companies we're working with, the big corporates, and helping to understand how a health system is utilizing software and how they can do that to help steer or create less friction. I mean, there's so much friction in healthcare when you just go and schedule an appointment to see your physician for a checkup or on these elective procedures. So where you have a choice on who you go to see, health systems have to have brand equity and connectivity with their patient in order to capture that patient. And so device companies are well positioned, I think, to be huge acquirers of software and digital health companies. And we've started to see this to some extent, but a lot of, again, the siloed nature of healthcare, if I'm able to identify a patient that needs a total knee and would benefit from my implant, just using total knee, a knee replacement is an elective procedure, semi-elective, and they can choose where they want to go. And you have to operate around the edges. And one thing I learned in how Amazon and big tech thinks is why we have Siri and Alexa, and because when you decide as a consumer of healthcare that you need something, you want to be readily available and the first to connect with that patient to help steer them, right? And so in your Google search or when you pick up the phone to call your provider, we want as a provider to be viewed as the best quality and patient and most hospitable to address your needs. And we want you to have a good experience. And, a lot of that is the device that's used and the tools that are used in that procedure that can help move a procedure out of the towers of hospitals and into an outpatient, lower cost setting that allows them to go home same day. And if you're able to steer more patients that way and qualify them on the front end, you're going to have better outcomes. And if you have better outcomes, you're better positioned as a device company. Does that make sense?
No, it makes complete sense. And, I think, uh, the problem, one of the things about our industry, and this is why, like, I have the show, this is why I have people like you come on, is for us to get exposure to new ideas, and more importantly, like more models of thinking. I think that there's this continuous perception or belief that it's like, hey, if we have a great technology that provides great patient outcomes, like, then we're good. We got a company. And I think those are just like table stakes now. I think there's so much like, how's the hospital going to make money from this? How does the clinician, aside from making their job easier, like, does this put the physician in a position to be a thought leader and sort of extend their career among their peers? There's all these things that I think we need to get better about asking questions around. And I'm hopeful that, like, at least founders who are listening to this kind of show and listening for people like you are taking that and saying, and sort of putting a little bit more strain on their models in terms of the business that they've built and what they're doing. Because I feel like, I don't know, there's a lot of assumptions that we've held as an industry and they need to change. Something I'm wondering if you mentioned how we were talking earlier that a lot of like LPs are more interested, because of the risk involved and that the way the markets are today, they're more interested in more sound investments that you're seeing, that at least the company's commercial. And let me put it this way: less so on PowerPoint companies and more so on spreadsheet companies. Because you have a spreadsheet company, you're able to make a better investment because you're like, okay, like, I know the risk, versus if it's a PowerPoint company, it's like pure risk, right? Do you see the strategics playing a bigger role? Because, like, somebody has to fund the PowerPoint companies. And for the audience who may not be following along, I'm talking about early stage companies that could be pre-commercial, pre-FDA clearance, etc. who do you see funding those companies? Do you see it coming more from the strategic side? Maybe these larger tech companies, like where's that money? Do you think? Where do you think it's going to come from?
Yeah, certainly strategics, and we've seen increased capital deployment from strategics and earlier stage companies. There is an innovation engine here that's better than anywhere else in the world. So, my comments around inefficiency and the challenges that are plaguing our system aren't, take that with a grain of salt, because this is the most innovative country, and technology is born here first. So I do see strategics investing more, and I think they're great partners. I really do. I think earlier in my career, when strategics started playing around in the space a little bit more frequently, there was hesitation. But I think attorneys have gotten very good at structuring how to balance their involvement and structure it. And I think strategics have equally been a little more accommodating and understanding of the games that we play and what attracts additional capital. What I don't think a lot of entrepreneurs have an appreciation for, nor strategics, is, our innovation ecosystem is built on finding voids in the market and needs for innovation, right? So better solutions, and smaller companies that are nimble and willing to take those risks are better positioned to address those. And, big corporates have cut R&D spending and continue to do, because we are their R&D, and early stage companies are their R&D and where they acquire growth and potential. I say all that because when you invite a strategic into the company, you need to understand or question yourself. Now, am I making this decision, this strategic decision, because I think it's what that strategic wants, or I think it's what the market wants and what the market needs? And when you have that parent or that person in the room that may steer your discussions and strategy, I think it's important to have that balance, right? I mean, the way innovation works here is because small companies find and listen to where the market is going, rather than listen to what the strategic specifically wants. I always, my North Star is build the best business that you possibly can, and you will get bought, right? You want to be bought,
There with you on that, man.
not sold. And if you, when you add a strategic in and you start listening to the direction they want to go, you start thinking, okay, how do I sell this business to them? Versus how do I get bought by all of the competitors and the market, whoever finds the value in that, by efficiently going after and filling a void in the market and benefiting the market. So just something to think about as we see increased strategic dollars, and I think that's great, and it is should be welcomed by the industry. You just have to balance it.
No, I completely agree. I gotta comment on something because like it's fresh on my mind. I'm wondering, as an investor, what are your thoughts on this? Which is, I've had so I have my agency side. We work with medtech startups to essentially help them get commercial traction and growth using AI and social media, and more importantly, to not spend hundreds of thousands, even millions of dollars on a huge sales team, right? And I talked to two different heads of marketing this week, whose response was, well, like right now we're on a limited market release, totally cool, and we're not worried about top of funnel, like we're not worried about like pipeline or everything. And my belief is like, well, when do you want to worry about that? When you're fully commercial and you have all this pressure and everything, and that's the time to do it. And I feel like there's like the moment you have a company, you should be thinking about, how do I build a commercial pipeline? And okay, great, we don't need to sell to all these people, but let's get them in, because it's going to take time for them to be nurtured, educated. Not everybody sits at the very beginning of the adoption curve. There are people who are in the mainstream market who will not buy until there's certain things that are satisfied. I just think it's insane. I'm wondering, like, your thoughts, because you're an investor in commercial companies. Like, what do you think about that?
I think each company, each market, each business is different. And a lot of our job is understanding the unique qualities of that business and market and helping to strategically and efficiently capitalize it to go after that market. I think oftentimes, um, I've always led investments that I've done, n- not because because trusting that others will do the work for you is an easy way to be wrong. One, and two, you don't add as much value if you don't understand the business as well as the entrepreneur. And I want to, as I said previously, be add more value than what the cost of the capital is to a business. And so I think it varies. I personally think that if you don't understand how the market will adopt a technology or how customers will respond to how long the sales cycle is, the value prop may not be articulated clearly or well enough yet, that if you overfund that engine, you don't meet that milestone that you have to get to. So, for instance, if you take on 10 million to invest in a business, this math is really easy to do, even for me. But a lot of entrepreneurs don't quite appreciate this. If you take on 10 million, that typically has to have a 2, 3, 4 times return. So 10 million has to turn into 20, 30, 40 million in this space in innovation based on the risk profile and, or even more. If you are not able to spend that 10 million efficiently, then you cannot create that 20, 30, 40 million in value. And when you don't do that, your shareholders, your management team, your founder shares are diluted and it's harder to raise money. And the investors that you just brought in, you're doing them a disservice as well. And so it's simple math. If you don't have that visibility that you can, these dollars can efficiently grow that milestone that's set upon financing to the next level, then it challenges. It's a challenge. And there's too often I've seen great technology and in a space where patients need it, right? I mean, in where we invest, you can potentially save lives and have a huge impact on quality of life. And if I, as an investor, ruin that, then I can't sleep. I mean, I would struggle with that because of something that I did wrong or a cap table that, it becomes the cap table that takes a business out or drives it into bankruptcy. I mean, my job is to help enable entrepreneurs realize their vision and execute and bring that novel technology, device, software, or service to market to better the industry. And by doing so, we all make money.
I agree. No, I completely agree. And I think like my biggest thing about this, and you touched on it earlier, I completely agree with you about like assessing the market, because at the end of the day, uh, you want to be an average to bad entrepreneur with a great market, right? I think like in one of my and of course, like there were some great operators and entrepreneurs there, but like Intuitive Surgical is a great example. I mean, why is Intuitive's market cap bigger than Medtronic's today? They're in a market where the pull was just so strong, right? And I think that the more you're able to test your assumptions and get tangible qualitative and quantitative data back, the better. And so I feel like even your assumptions on who's going to adopt a product ahead of commercial launch is like really important. And I really stress it to founders, which is like, hey, you might be pre-commercial, but like doesn't hurt to get 100, 200, 300 potential deals in your pipeline so that when you are commercial, you say, hey guys, all right, we just got some money in. Like, where do we want to hire somebody? Where should we focus? Versus they don't have that. And usually the first thing that I see is like they hire like, I don't know, 5 or 10 sales reps. And it's like, hey, hit the streets and let's see what happens. And now it's a 1-year experiment. I don't know about you, but like I get sad every time, unless it's needed. I get kind of sad whenever I see a company, especially in medtech, they announce it like, hey, we just raised $200 million. And I'm like, oh no, it's a lot of money, you know?
Yeah.
So
Yeah. No, it is. And that calculus becomes pretty easy to do. That 200 has to turn into 400, 600. And at that level, it can happen, but only a select number of companies can afford a $600 million business. And that's just to pay back the investors that just put the money in, not anybody else, which is not where you want to be. So, um, no, I agree with you. I mean, I always want to bet on good entrepreneurs though. And good entrepreneurs find a way to make a push market a pull market if it's not. Or they identify where is the pull. And in building a sales and marketing team, you always want to enable that pull, right? Rather than push type market. And it's grossly simplified there. But when you find a pull, a market that pulls you into it, that's the best place to be for rapid growth and adoption.
I completely agree. David, I really appreciate you coming on the show. I definitely want to have you back, but just in wrapping up, any sort of last words of advice, specifically for some of the entrepreneurs who are listening? Maybe a good one is, what are some things that get you to pass on deals? I know we covered that in the past, but like founders and entrepreneurs are like the worst salespeople when it comes to like reaching out to VCs. It's like always very selfish, needy based outreach. And I'm like, man, I was like, would you sell like this? I was like, cause this, reaching out to a VC or investor is a sale. Any tips or advice tactically or strategically you want to give?
Yeah, I mean, to be fair, I think VCs and investment managers are equally bad in reaching out to raise capital too. We all have to raise capital, right? And so, um, I don't want to be the kettle and the pot here, but what I would say is, I see a lot of opportunities, a lot of deals, and unfortunately, I have to say no 99% of the time. I won't give you the actual numbers, but it's a lot of deals and a lot of companies I have to say no to, and it's because of a lot of that calculus that I gave before, and my belief of whether I can materially influence and benefit the entrepreneur by partnering with them. And for entrepreneurs, this is every time the time that you spend with investors is time away from customers and managing the business, and you have to be very thoughtful about how you allocate resources, particularly when fundraising, knowing that math is out there. And most, that's the case. I mean, a lot of investors are professional no-sayers, and we're good at saying no or keeping things alive. And I think you have to move quick and recognize when it's likely to be a no, or it's not a potential fit, or it may be a year or two from now. And you got to get back to the business and running it. So, I mean, you always have to be fundraising, but that's feedback I would give, at least on the surface. And so,
No, I completely agree. Well, David, look, we really appreciate you coming on the show. For those who want to follow along, I know you're active on LinkedIn, but how else can people reach out? Maybe learn more about you and the fund.
yeah, always responsive to emails and LinkedIn, and it is hard. And if I can be helpful, I'm happy and eager to do that. By eliminating some mistakes here and there and helping to guide, it just helps the ecosystem that much more. And I know the good entrepreneurs, the world has enough bad golfers. They tend to come back again and are glutton for punishments and starting businesses. And so, I intend to be. I've had a good long career so far, and I intend to have an even longer one. So.
Fantastic. Well, David, really appreciate you coming on the show. For the audience who's listening, check out the show notes below. Be sure to check out Windham's website. Follow David on LinkedIn as well. I'm your host, Omar M. Khatib, and we'll see you all next time. Thanks for checking out this episode. If you want to do me a big favor and join so many other people who have helped grow this podcast, take a second and look below. If you're on Apple, give us 5 stars and write a short review. If you're on Spotify, just give us 5 stars. And if you're on YouTube, hit the like button. And most importantly, if you can, subscribe. We release so many different episodes that you may miss. Be sure to subscribe and turn your notifications on. You get extra points with me if you subscribe across all 3 channels. Thank you so much. And if you felt like this episode helped you, send this to somebody who'd really enjoy and appreciate it. Share and spread the love. We'll see you all next time.